I want to get the investor take on all of this with Thomas Peterffy. He, of course, runs and is, I should say, the founder and chairman of Interactive Brokers. Thomas, it's great to see you. As you just heard, we're going to have a whole conversation, I think, today in Washington about payment for order flow. And I know it's such a complicated topic, but the question that I think everybody is trying to understand on a very technical basis is if companies like Robinhood, like yours, had to use just what they call lit exchanges, rather than to go through the Citadels of the world that are paying for the flow and whatnot, would they get better execution on price?
My belief is the short answer is yes, but let me explain why I think that. So high-frequency traders and brokers who sell their orders to the high-frequency traders say that the executions are better than what is displayed in the public markets. And in addition, the brokers get paid for the orders so that they can afford to charge zero commissions, and therefore the customer is better off. This sounds like a very compelling argument, except for two things. One is the high-frequency traders succeeded in diverting nearly 50% of the order flow from the public exchanges. And as a result, the public exchanges have become less liquid, and the bids and offers have become wider. So, yes, obviously, they give a slight improvement over the bids and offers, which they have now succeeded in making wider. The second issue is that due to the lesser liquidity in the public markets, more and more institutional traders do not want to show their orders publicly because they don't want to push the markets against themselves. So instead, they provide Interactive Brokers and other brokers with their orders that we are keeping in the dark, but we trade them against the order flow we get in, so that many of these executions take place at the mid-price, and that is a good thing, and that is now a slowly evolving trend.
So, Thomas, it sounds like it may very well be that today, right now, you would get better execution through a Citadel or a high-frequency trader. But what you're suggesting is that you need to remake the whole system because the system has been remade by these high-frequency traders, which have therefore perverted the market in some way. Is that right?
So I'm saying that the system is remaking itself as we speak.
And so if you were a sitting senator thinking about these issues, a policymaker, perhaps you could pretend you're going to be Gary Gensler at the SEC, what would you do?
I would do nothing.
You would do nothing, but you just said that the system isn't working.
No, I said that the system is in the process of remaking itself.
But just so then, and maybe I'm missing something here, if we think that customers are not getting the best execution because of payment for order flow as a function of this whole system remaking itself, wouldn't you want the SEC to unmake it or to remake it in a different way?
I would like the SEC on this topic to do nothing.
I'm confused why, if you don't think customers are getting the best execution.
Because customers are on the way towards getting the best execution, and very soon that will be the case. As more and more of the institutional order flow goes into the dark pools against which the customer orders get offset, they will get better executions than they ever have gotten before.
Shepard Smith here. Thanks for watching CNBC on YouTube.